Rising rates, a slowing economy, and the end of easy money. The U.S. real estate market certainly kicked off 2023 with a bit of a bang. Housing and rental properties have gone up and down throughout this past couple of years. We've got the Fed, inflation, and of course, fears of a recession on the horizon. So, in these last couple of months, could we be taking a turn, however? Is it a good investment now in this particular climate? We're going to find out right here on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for being with us. John Wallishin is here from the Chief Investment Office. I want to get right into what's going on with housing. John, great to see you. John, it's been a really interesting time. When I look at some of the data that you pulled together for new and even existing single-family homes, it's clear that housing is starting to slow. It peaked at somewhere around early to mid 2022. What's going on here? Is this a rate issue? Mortgage rates certainly have been higher with the Fed raising rates. What's happening in the space?
Well, first of all, thanks for having me, Anthony. I really appreciate it to talk to you. I think it's a lot of things. Obviously, the significant upward movement in rates we've seen has had a large impact. That and notwithstanding the fact that we've seen home prices, and you can see on the chart that's on the screen, from their peaks have pulled back a little bit. Affordability is still a real challenge. Now, I think the logical question that people would ask is, does this portend a crash of the housing market? And we've been pretty vocal about this over the course of the last 15 months. The answer is no. So we shouldn't confuse a slowing housing market with a crash. Could prices decline further? The answer is, of course, they could. And we'd be remiss in saying that. And I know in our business, they always say it's dangerous to say it's different this time. What we like to say is every cycle has its differences. And there are some key differences in this cycle. One of the biggest being that there is a dearth of new supply, whether it's supply of new homes or existing homes. And that's a significant difference from where we were during the housing bubble period. Another one is largely the quality of mortgage underwriting has been better. And so, look, the housing market, when you have a doubling plus of mortgage rates in a very, very short amount of time, it's only natural you're going to have a slowdown. But we think we're far from a calamitous situation in housing.
Right. So, in other words, you're saying we're not seeing any kind of a repeat of 2008, 2009, which, of course, whenever people hear housing, they automatically think about the Great Recession and what was going on then. So, we're not seeing that here.
No, and we certainly don't believe so. I mean, we've always contended the biggest risk when it comes to many sectors, and real estate is one of them, is policy. Now, we did see something recently from the FHA, which is overseen by the Department of Housing and Urban Development, where they are somewhat loosening lending standards. And the way they're doing this is by reducing the mortgage insurance premium that is attached to FHA loans. For anybody who doesn't know, the FHA does not actually issue loans. Think of the FHA as basically a big insurance company for generally lower, when I say lower quality, I'm talking about credit quality borrowers who tend to put very little down on their homes. So that's something we're certainly watching closely, because that was one of the big contributors to some of the challenges we saw in the housing market leading up to the global financial crisis. Now, I want to be clear, we are not saying this is going to portend another housing crisis, but we do watch policy very carefully. But that is, as of now, it's on a relatively small scale relative to the size of the housing market. But no, the short answer is we think the setup is drastically different.
Right. And just expand a little bit on the existing home supply. You mentioned that there was a dearth. How do you compare that to maybe the last decade or so as far as what's available right now out there in the market for existing homes?
Sure. So the existing home market tends to be the largest portion of the market every year in terms of sales. So if there's round numbers, 84 or so million single family homes in the country, the vast majority that get sold every year are the existing home market, and the balance are certainly newly constructed homes. And so we're sitting here today, and there's a lot of ways to look at supply. And the chart you have on here shows supply of both new and existing homes. But there's another chart that we have that shows both supply of new homes as well as months of supply. Now, months of supply we understand is a fraction, which means it can be impacted by rate of sales as well. But if a normalized market over a long history is about 6 months of supply, we're sitting here with about 3 months on a national basis. Now, there's no such thing as a national housing market, and we've been in a lot of markets recently where supply is well below 1 month. If you look at it on an absolute number, we're well below 1 million units, which is certainly well below long-term trends. And so one of the big issues that has really sort of helped bolster the housing market, even with the significant upward move in rates, is the absolute dearth of supply, which is completely different from where we were during that period preceding the global financial crisis, where home builders were building anything they could, and buyers were being given access to mortgage credit. This is a true story. I heard a very large public home builder on a conference call say, "If you can fog a mirror, we'll sell you a home." Which to this day I still shake my head about. Those days are, for all intents and purposes, gone. So those are some of the biggest differences.
No, let's great. Thank you, John. That's a good way to kind of segue into the next part of the conversation, which I think is the investment landscape here, because obviously you cover REITs, real estate investment trusts for the CIO. Are there opportunities right now, given everything you're seeing in the market?
Yeah, the answer is we think so. We think the answer is yes. You know, 2021 and 2022 were a tale of two different cities for REITs. 2021 was a banner year. The overall REIT index returned roughly total return 43 to 44%. Let's turn that on its head. 2022 REITs were down, give or take 26, 27%. And so, look, commercial real estate is obviously interest rate sensitive. Number one. Number two, it is a lagging economic indicator. And so, even though the current results look good, there's invariably going to be some fall off given the economic sensitivity. But we think we've seen unless we're completely wrong on our interest rate call, and interest rates continue to march up from here, and we think we're closer to the top in interest rates. We do think this is a time to start dipping one's toe into the publicly traded REIT market. It was interesting. We came into 2022 with a much more cautious view because valuations were extended, and we thought the opportunities in the private REIT sector were much more attractive. Well, that has been completely flipped on its head, given that the private REIT market performed quite well in 22 and public REITs had some challenges. Now we're going to get days, and today's a perfect day where we're seeing 10-year Treasury yields up 9 or 10 basis points, and public REITs are having a tough go. But the market is generally an anticipatory vehicle. And so we think there are a number of very attractive sectors and incredibly well-managed companies that, we might be a little early on, but as long as we focus on, quality, and when we talk about quality, we mean quality of company, quality of balance sheet, quality of management, quality of properties, quality of location, quality of dividend coverage. And we urge people not to chase yield for yield's sake. More often than not, if you chase yield just for yield, you'll get yourself into trouble. And so we've been very, very fortunate in the companies we recommended. We're seeing dividend increases generally across the board, and that's very, very good. So it could, this call may be a little early, but we'd rather be early than late here. And then we think there are a lot of high quality companies, particularly in subsectors that have some very attractive long-term supply-demand fundamentals.
Great, thanks, John. Before I let you go, and that's great, it's a great thesis to go with here, especially for investors. We've got about a minute left, but I just had to ask you, what's the rental market looking like right now? Because I know you look at those results as well. I know a lot of people, especially in the New York area, who saw their leases year over year up 30, 40% on their monthly rent. What's going on right now as far as you can see?
For those of you who live in New York, I wish I had a better story to tell you, but there is a dearth of new supply, and there's a variety of reasons why we're not getting new supply. You have pretty solid demand. If you're walking around Manhattan, you'd never know that there was a pandemic here, and so you have no real new rental supply coming on. So I think those of you renting apartments in New York, it's going to be a challenging situation. I think if you look in other markets in the country, 2023 is likely to be, and this is well known, kind of a supply heavy year in a lot of different markets and submarkets. And so what we've seen is, after an absolutely stellar year of rent growth in 2022, particularly across publicly traded REIT land, rents are starting to mean revert or go back to long-term averages. So again, if we take a view longer than 6 months or so, we think the rental market generally would be pretty good, both single family and multifamily.
John, thank you very much. I know it's a lot to discuss because the housing market is such a huge part of our economy, and it's great to have you join us here. Good to see you, John. And for more information from John and the rest of the Chief Investment Office, visit ubs.com/views. Plus, you can check out all the social media channels for UBS and Chief Investment Office content. And make sure to speak with your financial advisor if you have any questions. Until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.